There are 3 tax mistakes that every retiree should avoid. Now, if you're like most people, when you hear about a tax strategy, the first thought that comes to mind is that it sounds exciting, but it's probably meant for a business owner. Well, not today. In speaking with hundreds of retirees every year, we see the same mistakes happen over and over again. So today we're going to look at the top 3 mistakes that we see and the strategies that you can implement to make sure that you're not paying more tax than you need to. And make sure to stick around for mistake number 3 because it's actually the opposite of mistake number 1 and 2. The first mistake that we see is that there is no plan in place to tax efficiently draw down the portfolio in retirement. This leads to significantly more tax being paid than is required. Mr. and Mrs. Retirement had a portfolio made up primarily of RRSPs with a little bit of money in TFSAs and a non-registered account, and their portfolio amounted to just over $1 million. They wanted to be able to spend $6,500 per month adjusted to inflation until they were 90, but they had no real plan as far as how to draw down their portfolio. Their current advisor had recommended that they not withdraw money from their RRSPs, but instead use their TFSAs and non-registered account. This would keep their tax bill as low as possible today because they would be deferring the withdrawals on their RRSPs. Mr. and Mrs. Retirement's retirement plan was on track and it was 107% funded. However, there was one red flag that they were not aware of. By planning until age 90, Mr. Retirement lived a couple years longer than Mrs. Retirement, and once he was 90, he still had $886,000 left in his registered account, which was now a RRIF. The issue with having so much money left in a registered account at death is that the entire amount is taxed in 1 year. After accounting for taxes, Mr. Retirement's estate was valued at $403,000. This means that over 50% of his RRIF went toward paying the tax bill. By implementing a tax-efficient withdrawal plan, we could improve this outlook dramatically. We targeted a taxable income of $41,000 per year for both of them, and this meant that we would be using their RRSPs much sooner into retirement. This would allow their TFSAs more time to grow tax-free. By implementing this strategy, their RRSPs were all used up prior to Mr. Retirement turning 90. By making this one change, their retirement outlook increased to 113% and their net estate value increased by almost $400,000. Needless to say, having a proper retirement withdrawal plan in place can save you thousands, if not hundreds of thousands of dollars in taxes throughout your retirement. Now, if this is an area you need help, then complete our retirement withdrawal questionnaire. You can find that in the link below. It takes about 5 minutes to complete, and I will send you your very own personalized video with some retirement withdrawal strategies. The second mistake that we see retirees make is misusing their TFSAs. The tax-free savings account is an incredible tool to use in retirement, but it is often misused, resulting in missed opportunities. Although it's called a tax-free savings account, the money that you put into it doesn't have to stay in a savings account. You can put that money in stocks, bonds, mutual funds, ETFs, so there are some growth opportunities available. Generally speaking, most retirees will have saved for their retirement using a variety of accounts. And in most scenarios, like Mr. and Mrs. Retirement, it often makes sense to leave the TFSAs to grow tax-free and use up the other accounts first. Since they won't need to use their TFSA right away, that money can be invested more aggressively. So rather than using the TFSA as an emergency fund, in most cases it makes sense to be more aggressive as all of that growth will be tax-free. Whereas if you're more aggressive in an RRSP, all of that growth will eventually be taxed once you make some withdrawals. The third mistake that we see retirees make is that they are unaware of their annual income. This could lead to missing out on some government benefits, and to counteract this, we're actually going to do the opposite of mistake 1 and 2. Jim was single and retired at 65 with $1 million in his portfolio. The majority of that was in RRSPs, and he had $150,000 in his tax-free savings account. Jim was receiving CPP and old age security, and he lived a fairly frugal life. He figured that he would need about $30,000 per year from his portfolio to meet his expense needs. Now, if he wanted $30,000 from his RRSPs, he would actually have to withdraw closer to $43,000 to account for the 30% withholding tax on his withdrawal. This $43,000 would be added to his taxable income for the year. On the other hand, if he withdrew $30,000 from his TFSA, there would be no tax and it wouldn't be added to his taxable income for the year. This would keep Jim's income as low as possible and he could qualify for the Guaranteed Income Supplement, also known as GIS. This is an additional benefit that you can receive on top of the old age security if you have a low income. Based on Jim's current income from CPP and OAS, he would be eligible for a GIS benefit of $607 per month if he used his TFSA to keep his income as low as possible. That's over $7,000 per year. And if Jim kept doing this over the next 5 years while he used up his TFSA, that's $35,000 that he would have received from this benefit. If he uses RRSP to net out $30,000, he would not be eligible for GIS as his income would be too high. There are a lot of variables that come into play when putting together a tax plan, and as we just saw, one person's mistake might be another person's opportunity. If you plan to retire soon or you've recently retired, then check out this video for a stress-free retirement. Hit that subscribe button and we'll see you next time.